Simple definition and meaning of mortgage. What do you know about a mortgage? If you wish to understand mortgage meaning in simple words, then firstly we need to know that the word of mortgage is actually derived from French and mort is actually mean death, while gage indicates agreement or pledge. So, the simple meaning of mortgage would be pledge till death or agreement till death. In mortgage simple definition, it's a loan borrowed by the purchaser from lender to protect against property or home. Thus, a mortgage can say to be the transfer associated with a property interest to a lender or loan provider as being collateral or security for the debt that incurred to the borrower. The mortgage normally is getting involved with a financial loan of money. Another mortgage definition that we can use to describe as mortgage is a loan to finance when buying real estate property, generally by means of stipulated repayment periods of time plus interest rates. The borrower also can be called as mortgagor will offer the lender, which also can be called as mortgagee, a lien on the property or home as collateral or security for the mortgage loan that the borrower received. A simple interest mortgage means that a mortgage in which interest will be calculated every single day. This can be very different compared to a conventional mortgage in which interest is calculated from month to month. By getting a simple interest mortgage, the charges on the interest will be calculated by dividing the rate of interest into 365 days. The number is then multiplying with the outstanding balance of the mortgage. If you want the interest charge for every month, you can just multiply the interest charge every day with the number of days in that particular month. Since the total number of days calculated by using the simple interest mortgage calculation is higher compared to a conventional mortgage calculation, therefore, the sum of the interest paid off over a simple interest mortgage is going to be a little higher compared to a conventional mortgage. There are 4 types of mortgage instruments which can be commonly found in the USA mortgage term. Below are the details of each instrument. 1. Mortgage. In some states, a mortgage will generate a lien on the title of the property. Foreclosure of the lien will always in needs of a judicial court proceeding declaring the debt to be due or in arrears and instructing to sell off the property for debt repayment. 2. Security deed. A security deed is actually a paper proof in which a lien on a property or home is taking place. Normally a lien is placed on the property or home when the borrower owes a considerable financial debt. 3. Deed of trust. For a deed of trust, it will comprise of a third party which is getting involved in the instrument referred to as trustee. A paper or document that signifies the agreement between a borrower and a lender for transferring an interest in the land that belongs to the borrower to a fairly neutral third party known as a trustee, to secure the debt repayment by the borrower. 4. Foreclosure process. The foreclosure process will be considerably quicker to obtain a deed of trust compared to a mortgage, which can be as fast as in 3 months' time instead of waiting for a year. Since foreclosure doesn't call for actions via the court, thus the cost for the transaction tends to be very little. And for your information, you will mostly find the deed of trust in the state of California. Simple meaning of real estate financing. Real estate is involved with a piece of land, which consists of the ground below it and the air above it, as well as any structures or buildings constructed on the land. Real estate consists of residential and/or business properties and tends to be marketed either by the person who owns the property or by a realtor. In the United States, most of the real estates are a lawful designation, as well as being subject to legal procedure. For your information, sometimes we can also call real estate as realty. One of the biggest investments you can make is buying your own house. However, this can be a daunting task if this is your first time doing it. There is a lot of terms that you do not understand and you might be caught off guard when you start paying your loan. Before you proceed with property purchasing, you need to know how mortgages work, how much money will be required, and the different types of mortgages that you can avail.